What is financial management? Its types, functions, and goals. You will learn about financial management in this video. I'll go through what financial management is, what it aims to achieve, what it can do, the functions of financial management, and the many types of financial management. Let's get started with the video. The diplomatic planning, arranging, directing, and supervising of financial endeavors in an organization is referred to as financial management. It also entails applying management ideas to an organization's financial resources while also contributing significantly to economic or budgetary management. There are numerous financial management alternatives available to everyone. This could include managing them on your own, hiring a full-time staff, hiring a part-time accountant, or hiring a third party, such as a chartered accountant, to handle all finance-related duties for you. Typically, businesses have a designated department that oversees the company's financial activities. Within an industry, a finance manager is hired to oversee finances and manage resources. At this role, they make all financial decisions. Financial management objectives. 1. To optimize profits by providing information on rising raw material costs, which could lead to an increase in the selling price. Number 2. To ensure adequate returns to shareholders, which will be determined by earning capacity and market value of the shareholders' assets, among other factors. Number 3. To monitor liquidity and cash flow to ensure that the company has adequate cash on hand to meet its obligations. 4. To guarantee that money is used efficiently. Once funds have been obtained, they should be put to the best possible use at the lowest possible cost. 5. To ensure investment security. That is to say, money should be put into safe investments with a reasonable rate of return. 6. To devise a viable capital structure. A solid capital composition is necessary to maintain a balance between debt and equity capital. What does financial management entail, or what are the responsibilities of financial management? Any organization's finance department is responsible for a variety of tasks, including determining the required capital. The financial manager must calculate and estimate the amount of money required by the organization. This is determined by the firm's regulations regarding required expenses and profits. When selecting capital structure, the amount expected must be calculated in such a way that the organization's earning capability grows. After determining the need for capital funds, a decision must be made about the type and proportion of various sources of funding. The financial management must determine the appropriate capital and debt combination, as well as the short-term and long-term capital ratios. This is done in order to reduce the cost of capital and increase shareholder wealth. Selection of funding sources. Before making a precise acquisition of funds, the finance manager must investigate the sources from which the funds will be obtained. Equity investors, preference shareholders, debenture holders, banks, and other financial institutions such as public deposits can all help the management generate funds. Capital investment. To acquire more cash and earn consistent returns, every organization or corporation must invest money. As a result, the financial manager must invest the company's capital in safe and profitable businesses. Acquisition of funds. The finance manager is responsible for obtaining the funds required by the company. Consultation with creditors and financial institutions may be required, as well as the distribution of a prospectus. The cost of raising funds is dependent not only on the cost of raising funds, but also on other factors such as general market conditions, investor decisions, government policies, and so on. Profit distribution. It is the financial manager's responsibility to allocate the organization's net profit efficiently once it has been received. This may need retaining a portion of the net profit for emergency innovation or expansion, while another portion of the profit can be used to reward shareholders. Financial control. Financial managers must not only plan, organize, and obtain cash, but they must also manage and assess the firm's finances in the short and long term. Financial techniques like financial forecasting, ratio evaluation, risk control, and profit and cost control can help with this. Now we'll look at the many sorts of financial management. There are primarily 3 forms of financial management studied in financial management studies. 1. Capital budgeting. It has to do with figuring out what needs to happen financially for the organization to achieve its short-term and long-term goals. What should be done with capital funds to boost growth? These management groups are also in charge of raising and investing funds. 2. Structure of capital. Figuring out how to pay for operations and growth if interest rates are reasonable. Taking on debt could be the best solution. A private investment company may also be approached for finance. Where appropriate, consider selling assets such as real estate or capital. When the team mentions capital structure, they are presumably referring to a company's debt to equity ratio, which indicates how financially sound or unstable a firm is. 3. Management of working capital. Working capital management is the process of a company's bookkeepers and accountants maintaining track of current assets, current debts, cash flow, inventory, turnover ratio, working capital ratio, and other financial metrics. Working capital management's primary goal is to ensure that the company has enough liquid cash on hand to pay its short-term obligations and operating expenses. This is a sort of financial management in which the team must maintain working capital management in order to smooth the company's operational cycle while also increasing earnings. Alright, that concludes today's topic. If you found the video useful, please give it a like, share it, and subscribe to our channel. Bye now!